Hello and good afternoon, everyone. Welcome to our live interview on emerging markets. Today, we are going to embark on a global journey. We're going to talk about the very best companies and some of the fastest growing parts of the world, from Asia to Africa to Latin America. And for that, we're going to speak with Nick Payne. Nick is the head of emerging market strategies at Jupiter Asset Management. He manages the Jupiter Asset Management Emerging Market Focus Fund. Nick, hi, welcome to our program, so to speak.
Good afternoon, thank you for having me.
Just before we begin with the interview, a couple of general remarks. Since this is a live recorded interview, you are very welcome to ask questions. Please write them down in the Q&A section or Q&A bar you find at the very bottom of your Zoom screen. And of course, you can also write them down in German if that works better for you. That's no problem whatsoever. And I'm going to try then to weave them into our conversation with Nick. Secondly, we are going to record this interview and we'll put a replay later on our website, themarket.ch. I guess it will be up on our web page sometime, I guess, tomorrow morning. So if something really specifically interested you about the interview, you can just go to our website and check it out again. Without further ado, let's jump right in, Nick. Maybe would you mind give us a short introduction of what you're doing and about your fund, so we have an idea what your focus is on when it comes to emerging markets?
So of course, yeah, and again, thanks for having me. For those of you who are not familiar with Jupiter, we are a London-based and London-listed asset management company. We currently look after around $80 billion in client assets across equities, fixed income, and alternatives. And the one thing that most of the strategies at the firm share in common is they are kind of high conviction, truly very high active share type strategies. And the strategy that I manage, which is the Jupiter Global Emerging Markets Fund, is no different. We run a very concentrated sort of about 30 stock portfolio, looking for the best companies we can find in the wonderful world that is emerging markets. And so we have a very high active share, very sort of concentrated portfolio, and we aim to basically be long-term holders of these fantastic companies.
Oh, that sounds interesting. How do you pick those companies? What is your investment process, so to speak?
So we look at, if you think about the emerging universe, it's enormous. It's 26 or 27 different countries, a very mixed bag of all sorts of different things, from, as you said in your introduction, from Latin America, from the Middle East, from Europe to Africa to Asia. We spend a lot of our time actually working out what we don't want to own, because there's almost too much stuff. We always say the paradox of choice is there's too much choice. So we try and spend our time narrowing it down. And ultimately, what we want to get to is a very narrow, small universe of what we think are the best. And in simple terms, what we're doing is we're stock pickers. So we're looking to try and find truly, truly exceptional businesses that we think can do what we call super compound, which means they can compound returns inside their business over many years and have a long runway to grow. And in doing that, we look for three main things. We look for what we call our three-pillar model. So the first thing we look for is businesses that are very profitable, have very high profitability of capital. So they display very high return on invested capital or return on equity, if you're familiar with those measures, the sort of pure test of profitability. The second thing that they must have is what we call a moat, to borrow the term coined by Warren Buffett. Think of it really as an analogy for your castle surrounded by the sieging forces of competition. In other words, in shorthand, your business must do something really special. Technology, a brand, the network effect, switching costs, something that stops everyone from doing it, allowing you to keep earning those supernormal profits in pillar one. And the third pillar we look for is growth. But we really mean growth by compounding, and that is growth by taking the great free cash flows that these businesses can earn and reinvest in the business, doing much more of the same thing. So that's how the kind of compounding comes from over, 1 year, 3 year, 5 year, 7 year time horizons and beyond, just doing one or two things really, really well.
Very interesting. And especially against today's background, I mean, the world is, so to speak, in flames. We have high inflation, rising interest rates, central banks are tightening policy, and now we also seem to be heading towards a recession. How does that impact your investment process? Are you seeing now new opportunities maybe showing up through this kind of revaluation we also seen in the stock market?
Well, yeah, you're right. It's a very noisy time, isn't it? A very uncertain feeling time. And the one thing that we like to focus on in the businesses that we buy is resilience. So businesses that can weather downturns. So typically one thing we look for is businesses that are basically use very little or no debt. So, for a lot of people, emerging market equities are kind of quite a long way up the risk curve. And we think about risk in business terms. And in a volatile asset class, we don't need to add more risk by having companies that are basically heavily geared. Because when downturns come, that exposes problems. So we buy a portfolio of companies that's resilient in terms of the businesses, not the stock market. In the short term, the stock market can go all over the place as it is doing at the moment. But in terms of the business risk that you own, so minimize the balance sheet risk. And then talking about those three pillars, if businesses earn high returns on capital, they typically have very high margins. And high margins give you room and they give you pricing power. So in inflationary times, typically what we would expect a lot of our portfolio companies to be is to be able to pass on inflation over time. But I emphasize it over time. If you're seeing 10% inflation, it's unusual for a business to be able to put its prices up straight away 10% without having some impact on demand. But being able to slowly, incrementally move prices over a period of time is what allows them to preserve their margins. It also, high margins and that kind of quality resilience, it's very high quality businesses, typically give you room, if you need to be flexible on business strategy. If you need to cut prices a little bit, if you need to help your consumers by not passing on prices and absorb that in the margin, it's much easier to do that if you've got great companies that are really resilient. The current turmoil is throwing up some really, we think now, some very interesting valuation opportunities. We've come from an era of the last 2 years where markets probably got a little bit frothy, particularly in the kind of companies that we like, the quality growth companies. But the repricing of those has been so fast and so vicious over the last literally 5 months or so, that it has brought down all of that kind of 2 years of post-pandemic froth. So we think a lot of these businesses now look, very, very attractive. I'll give you a case in point. Taiwan Semiconductor Manufacturing, TSMC, the world's largest maker of contract manufacturer of silicon that we need in everything we use in our daily lives, is now back down to sort of just under below its kind of long-term average of about 15 times earnings, having been as high as kind of 25 times or so in 2021. So, a leading global bellwether, arguably one of the most important stocks in the world, now looks much more reasonably priced than it probably did a year ago.
Very fascinating, and you're right. TSMC is really one of the most important companies on the planet. Without their chip processing technology, we couldn't have the most advanced computer technology. And I mean, the question is now, when it comes to TSMC, also a little bit, they have large customers from the US. They have Apple is, as far as I know, their biggest customer, Qualcomm,
That's
Broadcom,
correct, yeah.
all the big chip, the fabless chip manufacturers, so to speak, the chip companies who don't produce their own chips and source it out to TSMC. How are you kind of putting that into your models when you see that maybe an Apple or those other, or the handset market in general, which is also a problem for Qualcomm, I guess, is cooling down? Or are you just kind of looking over that cycle and focusing on the long term?
Yeah, it's very much the latter, Christoph. I mean, if you think about the 3-pillar model I talked about, TSMC has got to where it is because it's very profitable. It has an incredibly strong moat or competitive advantage through 40 years of intellectual property and technological process. And how has it got there? Because it's all of its free cash flow is spent on research and development, pays a dividend, and then the rest is all spent on research and development and CapEx. So last year, I think it spent something like $5 billion on R&D and runs sometimes 2 shifts, literally a day shift and a night shift on R&D. And then it spent $40 billion, it's expected to spend this year, $40 billion on CapEx. So you can see the lead it has is very difficult to break. And that is why the market has gone from 20 years ago, there were 20 odd players making leading edge silicon. There are now 3. TSMC, Samsung, and Intel makes for itself and is so far behind, it's actually having to get TSMC to make some chips for it. But you're right, so TSMC over the years has broadened its customer base. It used to be very PC dominated, then very smartphone dominated. And it itself is saying that it's seeing some softness from clients in the consumer electronics end, things like Google Chromebooks and some of the other electronic applications. However, what it sees offsetting that is still incredibly strong demand from electric vehicles and incredibly strong demand from high performance computing, which is leading edge kind of servers and hypercomputers. So really, they are absolutely booked out, their foundries, in terms of the reserve cycle. And this is one of the reasons we like TSMC. You don't have to bet on which technology is going to win. You just have to buy the guys who can build it. As you said in your introduction, without these guys, it doesn't exist. So when we're all, driving around in flying cars, it's going to be very difficult for me as a manager to make a correct bet on which flying car manufacturer is going to work. But I'm pretty sure that the flying cars are going to use a lot of computer processing power that will use a lot of silicon. And guess who's going to have to make that? It's TSMC. So you've got a much more balanced business cycle. So the stock has come down because the market is expecting this kind of cycle. But TSMC themselves are saying, yeah, we're seeing some softness in smartphone and consumer end, but that's getting offset by the huge demand for EV and high performance computing.
Right, that's very fascinating indeed. And you mentioned Intel and Samsung Electronics, and of course there are others, Texas Instruments, Micron. They're all committing to billions of dollars of capex investment to build new fabs, be it in the case of TSMC, even in the US, and of course in Taiwan. Aren't you not, what do you would say to the concern that there's going to be maybe an overbuild and that we're going to have also some lean years ahead of us because these companies are all spending so much of their cash flow to build out new fabs?
We're not particularly concerned because one of the reasons we're not concerned is if you look at the structure, we've just talked there about leading edge silicon, 3 players. And then obviously there's been some overbuild because of the pandemic in maybe some of the legacy nodes.
Right.
And then you mentioned there Micron. And so if you think about memory, which TSMC doesn't do, but Samsung, Micron, and Hynix, because of the market structure has consolidated to effectively an oligopoly of those 3 companies control something like 95% of the market, they're generally now becoming much more rational. So when they see a demand expansion, they expand their supply, but not speculatively, which was always the Achilles heel of the industry in the past. Like the steel industry of old, high steel prices meant people built steel mills, which meant the cycle rolled over when demand and supply became imbalanced again. So what I'm saying is in both industries, leading edge silicon and leading edge memory, you've got effectively duopoly or oligopoly structures, which means everyone can be more rational and not trying to kill each other and take market share. So they have no real incentive to try and over expand. The other reason when you hear me talk about big dollar cost is the cost of making this stuff has just become so much more expensive over the years. So what cost, $1 billion, 10 years ago now costs $5 billion to do, because the leading edge gets harder and harder to find, which again reinforces the advantage. So just because it's spending 2 or 3x more dollars doesn't mean that's 2 or 3x more supply. because it's so expensive to actually make leading edge memory and leading edge silicon processing power.
So the industry is much more disciplined, basically, than in previous cycles. So
exactly, it is, and you know, whether the cycles go in and out. I mean, I think our point here is that the medium-term direction of travel, we think, for this is up, unless you believe that we as humans are going to stop innovating or are going to stop, you know, the exponential growth of the data that we all generate and consume, and therefore need to process, need to store. These things feel to me like they're continuing to grow at an exponential rate over the coming 5-10 years beyond. So whether we have dip down cycles or not in the short term, you know, the direction of travel to us still seems to be in that upward direction. And we are not in the business of trying to sort of time cycles too carefully. We think it's a bit of a folly to do that. You know, it's just extremely difficult to keep calling that. You've got to make two decisions right. You've got to know when to sell if you want to exit your TSMC or your Samsung, and then you've got to know when to buy back in. So you're making two very difficult decisions that you have to get right, you know.
Right, and the timing is always really hard to catch the right.
It's incredibly difficult, yeah.
And I mean, TSMC is the biggest, of course, semiconductor manufacturing company in Taiwan, but the whole country has, I mean, it's a hub, and basically almost all the chips in the world kind of pass in some way or other through the island. Are you having other investment ideas there when it comes to Taiwan?
Yeah, we have several stocks in the portfolio in Taiwan, many of whom do chip manufacturing or electronics. So we've got some wonderful businesses in there. One I'll highlight a couple. One is A-Speed, which is a small company. It's about $2 billion. But A-Speed is a wonderful little business because it makes something called a BMC, or a baseboard management chip. Now, this thing only costs $10, but it's the chip that goes inside every single server. And why is it important? Because it's the backdoor way into a server. So you can imagine the security implications of that. So that means when Intel or AMD or others design a new server chip, they get A-Speed engineers in very early in the process to understand the architecture. And so that A-Speed can design their chip that will work very well with that. And that trusted partner relationship, and the fact that the thing only costs $10 out of a total server cost of $3,000 or $4,000 or $5,000 means they can make really high margins and very high returns on capital. Because when the server companies are looking to save costs, they're not looking to shave, oh, well, take $1 off your $10 chip. So they have pricing power, which enables them to earn 60 or 70% gross margins. So we think that's a wonderful example of a business that's just absolutely the best at what it does. It has something like 70% market share in the world in this very specific bottleneck. And proof of this was TSMC makes the chips physically for A-Speed. A-Speed just designs them. And they realized that they would get a good place in TSMC's queue, because if they don't, this holds up TSMC's other customers. It holds them up basically getting servers because of this one tiny critical component. But we have other businesses in there, such as Advantech, which is the world's largest maker of industrial PCs, so the kind of thing that go inside automation of plants. It's got a great switching cost in there. Another business called Sinbon Electronics that makes the wiring harnesses inside wind turbines. It makes the in a very difficult offshore environment. It's windy, it's salty, it's hot, it's very cold, it's wet. Super high cable specifications. They also are instrumental in helping companies and countries build out their EV charging infrastructure. They make a lot of the cabling inside some of these kind of charging posts and things like that. So there's a lot of great kind of technology companies within Taiwan that we want to take advantage of, and they are about over 20% or so of our portfolio is invested there. Wow,
that's very interesting. My question is, of course, then when we look at Taiwan, we also think about the relationship to China, which has gotten more tense. At least that's what we hear in the news. How do you cope with that? I would call it maybe even political risk in general when it comes to Taiwan and China, especially also after the Russian invasion of Ukraine.
Yeah, with difficulty, because the reality is it's one of these events that's extremely difficult to price or to think about. You know, what we think. I mean, we do think it's actually a relatively remote possibility that if you think about China, if your question really is framed around China making an aggressive move towards Taiwan, it's no secret that China feels that Taiwan is part of mainland China, given the historic split. And Xi Jinping has made no secret of his desire to see a reunification at some stage. I guess I would make a couple of points here. One thing is talking about it. The Chinese have typically always wanted to do it via hearts and minds rather via military force. Second point, I think the Russian invasion of Ukraine and the West's reaction to it has probably given, you know, Beijing pause for thought if they were thinking about this kind of venture. You know, the thing that took us by surprise was the mobilization of using, you know, the US dollar, or specifically US dollar reserves, blocking access to them for Russia as a weapon, a financial weapon. You know, Putin had been running his US dollar dependency down over the last 8 to 10 years. China is interlinked very specifically in the global financial system. It has trillions of dollars of US dollar reserves and US dollar treasuries. So to sort of, you know, if the same kind of direction of travel was meted out, that'd be extremely difficult for them and also for the global economy. And the final point on this, because we often do get asked about this, militarily, it's a completely different proposition from a country which is on your doorstep with very large, wide open land borders that Ukraine has with Belarus and Russia. Taiwan is an island 100 miles off the coast of China with steep granite cliffs and limited beaches. It requires a very, very difficult aerial and then ultimately amphibious assault if you were going to take it by force. So it's a very different kind of proposition, potentially, to say a Ukraine of large, wide open land borders to roll in over.
Very insightful. And what are your thoughts on China itself? I mean, it's the biggest part, of course, of the emerging market universe. And we have seen some government crackdown recently on big tech. And even some people say Chinese stocks are not investable anymore, or Chinese companies, so to speak. How do you approach these challenges?
Well, I don't really believe that the second largest economy and an extremely dynamic source of technology and innovation is uninvestable. I think you've always had to invest carefully in China, and that is even more true today than it perhaps was. So a couple of these things in turn. So obviously we're aware of 3 main factors that have been pushing the market down. There's, as you mentioned, there's the regulatory tightening, then there's the economy slowing down, and then there's COVID. On the regulatory tightening, we believe that it's largely finished. What it really was, and it got, you know, one thing that as a sort of an experience, I mean, I've been doing emerging markets for 25 years, and we've been following China through this journey, is we often think that because China is a command economy, that what comes out of the official announcements is all kind of lined up and joined up. It isn't. It's often a little bit confused what comes out of which part of the government or the local government or the Politburo structure. So what China was really doing, there's 2 things: there's the common prosperity agenda of sort of leveling up, if you want to call it that, or, you know, the same challenges that we have in the West, you know, unequal income distribution, combined at the time with effectively wanting to tighten regulation on technology, which had run rampant and effectively had been the Wild West for several years. And this is, you know, several of the businesses were following fairly dodgy kind of, you know, anti-monopolistic type policies, and they just wanted to draw some clear lines in the sand about what was acceptable and what was not. And we think that's much, much clearer now in sectors like e-commerce, where Some of the companies would use forced exclusivity, so you must only be on my platform and not on this one. You know, they clearly said, well, that's not allowed, so you've got to be open. Any merchant can go on any platform. You know, fairly simple sounding stuff like that. Also, a lot of data. Chinese companies were taking huge amounts of data from their customers. We have a team member here who signed up to Didi, the ride-hailing app. It's the equivalent of Uber, and they literally said you have to sign over your contacts, your photos, everything. Now in Europe, we had something called GDPR, and then similar as you know, it's exactly that, putting this sort of stuff in line that you can only take necessary data rather than everything. So a lot of that we think is pretty sensible, and we think most of that's finished. Now, the economy is slowing because of China's own induced policies. It wanted to slow the real estate sector. It wanted to try and get a grasp of some of the worst offenders in that sector, such as Evergrande. So it's, in a way, it's been a self-imposed policy to be shrinking. And the third kind of perfect storm has been COVID. So if you think back to 2020, China, you know, had a relatively good kind of economic performance through COVID. The problem is the zero COVID policy has now made it very difficult for them to escape from that, whereas the rest of the world has kind of got vaccinated and moved on. And this kind of ongoing lockdown or low tolerance to COVID has really started to now have a serious effect on the economy. All of that is well known by the stock market, which is why until recently China was the world's worst performing stock market and had been basically in a downward market, a serious bear market for the past 18 months or so.
I'm sorry.
Please continue.
I was just wondering, you just spoke about the correction or the bear market in Chinese stocks. Did you use that kind of downtrend to add to some position? Or I guess my question is more, what are your best ideas when it comes to China right now?
So yeah, we have been adding over recent weeks to our exposure in China, from being kind of quite a long way below, you know, the reference benchmark way. We've now been increasing it because we think that ultimately COVID, the zero COVID policy, is a policy that will come to an end of life. We don't know exactly when that will be, but you know, China will have to learn to live with this. And what it really needs to do is vaccinate its elderly. That's the principal problem and the thing that the Chinese authorities are most nervous about. Because that elderly cohort is the least vaccinated, you know, ironically, given we know they are the most at risk of the disease. But ultimately, we think that policy can be reversed. And secondly, China is the only economy in the world that is now loosening. It's actually stimulating. You know, monetary policy is being loosened, whereas the rest of the world is tightening. And loosening is usually good for equity markets. And the final thing here is, I think we look at the rest of the world, particularly some of perhaps say the US or Europe, and we can see earnings risk. If we are as you mentioned in your introduction, if we are worrying about recession, we have to potentially be thinking about earnings risk, or at least the downgrade of expectations of earnings. Well, in China, that's what the market spent the last 18 months doing. So we would argue that the risk of a negative earnings surprise in China now is very low. It's actually more likely, and in the recent quarterly results that we were seeing from some of the big tech companies like JD.com, like Alibaba, you actually started, for the first time in nearly 2 years, you saw Wall Street analysts actually start to revise up their numbers. So we think the market is hated, is oversold, and you're actually seeing earnings begin to bottom out. So we think it could be quite an interesting market in China over the next couple of years. Yeah.
Fascinating. I think Alibaba is, you just mentioned it, is one of the biggest companies, one of the top 10 positions in your fund. What's especially appealing when it comes to Alibaba?
Just the dominance of its moat as the leading e-commerce platform. And a lot of people talk about how its growth is going to be slower. Well, it will be, because e-commerce is now 30% of retail sales in China. So it's not the Alibaba 5 years ago that was growing from 15 to 30% penetration. and it is now much more entwined with the economy, so it will feel it, just as Amazon now feels when the US economy slows down because it's such a big part of the economy. However, if we look forward, you know, why we ask ourselves, why can't e-commerce be 50% of retail sales? Plus the fact inside Alibaba now, you have Ant Financial, you know, a huge fintech within China, which now again looks like the regulatory picture's cleared out. You have the largest cloud provider in China. You also have the largest payment provider in China, Alipay, alongside Tenpay within Tencent. So you have a lot of incredibly powerful, strong businesses in there. And the growth is slowing down, but Alibaba and Tencent, we've always liked them because they're extremely free cash flow generative. They generate a huge amount of free cash flow that in prior years was typically reinvested into buying other businesses. We think that will continue, but perhaps under a bit more close government scrutiny. And we ultimately think that these businesses will probably start to throw some more of that cash flow back to shareholders. So in other words, these businesses are still growing. They're not the super fast growers that they maybe were 5 or 10 years ago, but they're still, you know, very, very, you know, effectively no debt on the balance sheet, still in a secular growth market and still very profitable, extremely cash generative.
Yeah, that sounds really like Alibaba could grow further, of course. And when we talk about China, there's also always the question about the environment. And what China does is they're doing heavy investments in solar, EVs, and other green technologies. And actually, we have a question from one viewer, and he's asking, maybe you can help answer us that. He's asking about the most promising battery producers for solar power to watch for in the near future. Do you have any ideas or do you have any positions when it comes to green technologies in your fund?
We prefer to play, you know, we're big believers in the transition, the energy transition. So as an aside, one thing that our fund does not do is we exclude investing in fossil fuels. So we're obviously very interested in the transition to energy, but what we've got to be very careful of, we think, is that you don't buy stocks because the theme sounds good. Because often we find that businesses in said attractive themes are actually not very good businesses, or the thing you were talking about is very, very competitive and not the kind of industry I'm talking about. So, you know, we own, I talked about Sinbon, the cable manufacturer. We think that's a very interesting way of kind of playing the green revolution, rather than just buying, say, for example, solar panel manufacturing. Because if I think about solar panel manufacturing, it's effectively a commoditized industry. You know, if I think about those 3 pillars, so returns on capital are low, because number 2, the moat, there's no real barrier to entry. It's very hard to be special, to differentiate yourself. So there's a lot of players, there's a lot of price competition. So one thing that we're really clear about in our process is you do have to understand the industry structure, not just that the industry sounds exciting or sounds sexy, is there a good structure in here? We talked about chips and memory, the oligopoly or the very high concentration power of the players. That's an industry that's more likely to earn long-term, good, durable, sustainable profits, rather than just sort of going out and buying solar. Batteries is something we've had a look at very closely, but we're not really, to be honest, completely convinced that there is really a lead in battery. There's a very good Chinese maker, we do not own it, called CATL, or I can't remember the full name, but it's Comparex is the first, yeah. There's obviously, in Korea, there's LG Chem now, LG Energy Solutions. But you've got to be very careful with these because they get very high multiples because people think, you know, it's very obvious that people can see that batteries are going to grow. The question is, will you make good margins and returns on capital from that growth? Will the industry structure let you? Or will it become very commoditized if VW make them in-house, if Tesla make them in-house, for example? So, that's a sort of a long way of saying we prefer to find a different way to play that, looking at somewhere where it's harder to compete in there, like those specialist cable manufacturers or some other such thing.
Perfect, thank you. Let's switch gear maybe for a moment and head over to Latin America. How do you see that area of the emerging markets, and what are your best investment ideas there?
So Latin America is having a good time at the moment because it's typically, it gets a terms of trade boost because commodity prices are high. So Latin America makes, effectively manufactures and mines, should I say, and sows and reaps a lot of things the world wants right now. So whether it's soybeans from Brazil, or wheat from Argentina, or copper and lithium from Chile, Argentina, oil from Mexico, Colombia, et cetera. So Latin American currencies have been pretty firm this year, reflecting that sort of good terms of trade performance. Medium term, we're a little bit more cautious on the region though, because it does tend to be cyclical because of that. And the other thing we've noticed in the last, say, 2 or 3 years is a very big kind of political move in Latin America, sort of left of center. We've just seen this weekend the election of President Petro in Colombia, who is much more left of center. His economic policy, he's talked about, for example, not granting any new licenses for any more oil exploration in the country, taxing the wealthier. So what we see across the continent is a lot more kind of populism, and that does concern us slightly, that it doesn't necessarily, and some of the, this region, some countries there that have been historically very well run, like Chile, like Peru, Colombia, have definitely made a move to the left, and governability has become a bit trickier, which can undermine investment confidence and ultimately the long-term growth rate of these economies. Having said that, there are still wonderful businesses there. I would highlight one that we own in our portfolio, which is called Localiza, which is Brazil's largest car rental company that has actually just bought its #2 player, so it's got even stronger and more dominant in its market. And Localiza has really been benefiting from a couple of things. They've got this very interesting pricing strategy where, in real terms, until very recently, the rental car price was falling. They were effectively trying to do is make it a lower and lower proportion of someone's income, which boosted demand and take above it. But they're also benefiting from a longer term trend of basically people moving away from car ownership to basically renting a car when you need it, not just the typical kind of vacation one, but leasing it, for example. If rather than owning it, you might want to lease it, and you might want to lease it for 3 years or a year, but maybe even only just for a few months. And the same thing with other things such as Uber drivers, the kind of gig economy worker who an Uber driver doesn't necessarily want to own a car if he's only going to work, say I want to work the holidays, I want to work 2 months. You can rent the car from Localiza for the 2 months and then hand it back rather than have to buy a car, insure it, tax it and sell it, etc. So really kind of helping with that fleet, better utilization of the fleet. And we've seen that business compound earnings at double-digit rates for many, many years. And we think it continues to have this great runway of growth ahead of it, because ultimately car rental, fleet usage by businesses, all of those things I've just talked about are still very lowly penetrated in the Brazilian economy, and have got ample room to keep growing. Again, Locally is a great example of a business that just does one thing really, really, really well.
Are there other ways to get exposure to your portfolio when it comes to Latin America?
Another business that we really like, that we were able to buy in the pandemic, in the kind of big sell-off in March 2020, is MercadoLibre, which, for those of you who don't know, is, it sometimes lazily gets called the Amazon of Latin America. It's present throughout the continent. But we do think, as an e-commerce player, it has an incredible lead, and we think it's now building that kind of network effect where the size of it begets more size and makes it harder and harder for the #2 and #3 players in the local markets to compete. And it does compete with Amazon, Amazon is a good player in some of the markets, but a very distant sort of fourth or fifth or sixth player in some of the big markets. It also has a payments business, Mercado Pago, just like eBay had PayPal embedded inside it. Mercado Pago is a very interesting business. Again, they're now getting more people using it off MercadoLibre's platform as a general payment wallet than on the platform, just as PayPal effectively outgrew eBay. And we know now, as PayPal is a widely accepted, kind of payment wallet around the world, we think Mercado Pago ultimately is going to do the same thing. But the key point for us here, I talked about China having about 30% of retail sales online. In Latin America, that number is only 9 or 10, between 9 and 10, depending on the country. So it's still in its infancy, it's still very lowly penetrated. So it can still grow at very attractive, sort of secular growth rates, despite retail sales being a bit flat because maybe the economy slowed down, because you're still seeing that transition from offline, onto online. So we think that's a wonderful business, and we're hoping to be able to hold that for many, many years to come.
Interesting. When we think about Latin America, many of us probably also think about inflation or its inflationary past. I think just Argentina I thought, or I heard inflation was 60% in May. How does a company like MercadoLibre, how do they cope with inflation? And I mean, you touched upon that topic earlier in our conversation, but can you maybe elaborate a little bit more on that topic?
Sure. I mean, one thing you've got to start with and have in your mind here is that most emerging markets are used to dealing with inflation. It's us in Europe and the US that are really have kind of forgotten what inflation is, because it's been so low for 20 years and even going back all the way to the 70s, but certainly it's been very low for probably the last 15 or 20 years. So whereas it hasn't been the case in emerging markets, they've had to learn to live with it. It's no coincidence that emerging market foreign exchange has been quite good this year, when despite the fact we're having a sell-off, despite the fact that Fed is raising rates, and despite the fact the dollar is strong, because a lot of people's first reaction is, oh, the dollar's going up, that's bad for emerging markets. Well, the currencies have been quite stable. Why is that? Because they all started raising rates last year. They could see inflation in their own economies, and they knew that the Fed ultimately would have to react. The people who are late here, arguably, are the Bank of England, the ECB, and the Fed in raising rates. So, remember, emerging markets are used to dealing with inflation. However, they're not used to always dealing with Argentine or Turkish kind of rates of inflation, as you said, of 50 or 60% annualized or even per month. But even businesses within Turkey or within Argentina are very used to dealing with this kind of stuff. They've had it, unfortunately, they've had to deal with it, many, many times over the last sort of 25 or 30 years. And so they do just get better at kind of managing prices, moving, and then prices change quickly in these economies, and most people get used to that. You certainly see that in economies like Argentina and Turkey, where prices might be moving, a couple of times a week. Something that would feel very alien to us, but that's just a sort of almost normal in a couple of these countries. But that other than MercadoLibre, for example, that is one reason why we tend to stay away from a market like a Turkey, because we do think the policy mix is, shall we say, very unorthodox. President Erdogan has very unorthodox views that high inflation is caused by high interest rates, and that's why inflation is 70% and the interest rate's 15%.
Yeah, you can clearly call that unorthodox, of course. Maybe towards the end of our conversation, let's take a look at Africa. How do you think about Africa when it comes to the construction of your portfolio?
Africa is a very interesting but still quite challenging region to invest in for the very reason we've just sort of alluded to, meaning often kind of political, but particularly currency stability. So we've invested, I mean, in the years I've been doing emerging markets, I have invested in Africa. We don't currently have anything directly in that region because we've seen issues with currency convertibility or with effectively capital controls, which mean our clients' money gets trapped in Nigerian naira or whatever it may be, and we're in a queue to repatriate it and we can't foresee the exchange rate. So we would typically shy away from areas like that where we're concerned about that risk, because that to us is a serious risk, that client capital gets trapped or is very challenging to kind of repatriate it. And so there's undoubtedly a lot of growth, there's a lot of potential there, but it's just finding it without kind of, navigating it without potentially getting stuck in it is very difficult, because ultimately what I'm trying to do with the Gem Focus Fund is compound returns in US dollars. We think of that as our base currency. So if I think I'm going to lose a lot on a currency like a Turkish lira or an African currency, I have to think, well, to get a 10 or 15% return in dollars, and I think I'm going to lose 20 on the currency, I've got to find something that's going to generate me 30% in a year, and that's hard, very hard to do. So typically we try and find it, we just try and make our lives easier and find countries where we think that's more likely that we're not going to get that kind of big currency drawdown working against us.
Perfect. Thank you so much for your insight. I truly appreciate it. Just since we're really at the end of our conversation now, is there anything else you would like to mention which we didn't touch upon, which may be important for our viewers to consider?
I guess the one thing that's just good to remember when you've got all this noise, all this volatility in the markets, and we often say this with emerging markets, is the importance of staying invested. If you are invested in emerging markets, it's extremely difficult to time it, and people often make the same mistake feeling that they can time it. We've done a lot of research that suggests if you miss just the sort of the 10 best trading days in any 1 year, 3 year, or 5 year, you massively damage your returns. And guess what? Your best days are often very near your worst days, when markets bounce around. So we would just emphasize that you've got to look at this asset class with a long-term time horizon. Personally, obviously I'm speaking my own book here, but we think, patiently investing in just a few of the best companies and holding them as long as you can is the right way to go. But you have to have a tolerance for, of sitting through noise and volatility and sitting through, and ultimately you'll do very well if you're just patient. The hardest thing to do in my investment process is, I always say, it's hard to find the companies. It's even harder to stay with the best and just sit on your hands and do nothing, or buy a bit more of them when the prices fall, particularly when you get all this noise. So stay invested and be patient.
Nick, I think that's a great closing statement. Thank you so much for your time and for sharing your insight. It was very fascinating to speak with you.
Thank you very much. Absolute pleasure. Yeah.
Okay, thank you. And for you in the audience, thank you so much for joining us today. I hope you find our conversation interesting and helpful, and you could maybe take one or the other good idea away from it. And as I mentioned earlier, the conversation is going to be up on our website, themarket.ch, later on. I guess it will be sometime tomorrow morning. And yeah, so thank you very much. Have a good evening and take care. Bye.
Thank you.
Bye, Nick. Thanks.